Sandeep, good morning. So good to have you on the show.
Thank you. Good morning.
Sandeep, how are you looking at the markets for the next year? Because this year has been quite a roller coaster ride. So after it has seen a sell-off in the past 3 months, do you find the valuations going ahead into the new year at least a little favorable?
Hi. So the way we look at market is that on the macro front there is lot of disturbance outside India as well. If you see, we are still in amidst some kind of some kind of unrest in the Middle East. There is also some kind of unrest which keeps brewing in other parts of the world. So that is one risk which we see. And secondly, everyone is right now very much focused on what President Trump does when he joins. My sense is that given by his going by his historical track record, when he joins 3 4 days, it will be a very volatile situation because he will definitely announce whatever he has said in the past in most probabilistic scenario, and maybe if there are some repercussions later on, they may be withdrawn or softened a bit. But to start with, all the things which he has committed, he will announce, and I think that is the time when everyone will start calculating what will be the new financial setup for their company. And I think till that time we will also witness a lot of volatility going forward. I think markets will settle in the end of January or beginning of February. Till that time we should be ready for a very bumpy ride in the markets. That is how I see it. And otherwise, India is doing well. We are growing well now due to elections and other reasons, other some state elections as well. We have seen some slowdown in capex in the first half, but we expect now again government capex will pick up, and along with that, private capex should also open up. And if that happens, then I think we will gain the momentum again, which we were saying earlier in terms of growth.
Okay, so when you say capex plays will gain momentum, do you believe that defense and railway stocks are expected to gain some favor in 2025?
See, again, the challenge in some of the stocks is that they are very, very expensive and they are building in a lot of momentum on spend already. So very hard to call that. But let me put it this way, that if government capex opens up, it does give a lot of money to the people in hand through direct and indirect measures. So many sectors which have not done well should also start doing well. And good companies which are at reasonable valuation across sectors should do well. Particularly in the manufacturing side, we are very optimistic because China plus one definitely continues to be a big theme, and we will see a lot of benefit coming in from there as well.
Okay. Sandeep, what about the export-oriented themes? Because we are seeing that the rupee has been depreciating. We're seeing record lows of rupee against the US dollar. So do you expect that the pharma IT names are expected to fare better in the first half at least?
So I think pharma and IT have rallied quite a bit in last few months because of one rupee, and secondly they have been considered as defensive. The only challenge is Trump being Trump. He will not allow anyone to make money easily, and we have seen in 2014-15 how a lot of noise came for localization in the IT services also. So my belief is that while IT services should do well and it should benefit from little bit from even rupee depreciation, but at the same time, we are yet unknown about the cost of doing business, which will happen after Trump coming in. Because if there is a tinkering with the number of people who should be localized and any other thing, minimum wages on the IT service side or something of that sort, or some kind of taxes or something, then obviously the cost of doing business has not yet been built in. What we are building in is a revised currency and good demand, which is expected to come on the backdrop of corporate tax cuts in the US. So I think all the positives are built in the tech sector, but we don't yet know if there would be any negative surprise. On pharma, I think, yes, again, the stocks have run up a bit, but again, in pharma, the good part, which is slightly different than IT, is that it will be very tough to increase the cost of doing business. So relatively, pharma may be a little immune versus IT, but at the same time, we should be cognizant that both these sectors have done quite well in last few months. So the valuations should be looked into it before making any decision.
Okay. Sandeep, you did mention that Trump being Trump, it's very hard for India to make money. So like last year, I mean this year, we saw that Nifty went from 21 to 26,000. But how do you see the next year? We are starting on 23,000 odd levels, 23,500. Where do you expect the Nifty to go? Can you expect like 27, 28,000 can we achieve?
So I think all the investors have to bring down their expectation of growth in the market. So I think this year investors should moderate their expectation. I would be more on lower double digit type of return expectation. I don't think that we will make the kind of returns we have made in last 2-3 years because it was combination of multiple factors. But yes, some of the stocks in different sectors which are reasonably priced and which are beneficiary of China plus one or government capex can give higher return. But on the portfolio level or at the market level, the expectation of return must be moderated substantially. It is not a market of 20-25% growth this year at least.
Acha, okay. 25% growth cannot be expected. But Sandeep, for instance, if a person is starting this new year with like 1 lakh rupees of investment, so where do you advise them to go? Which sectors, how should their asset allocation portfolio should look like at this point of time?
It is very difficult to again comment on the asset allocation and sector specific wise, but let me give a broad theme. I think you should always have good proportion of defensives like FMCG, consumer durable. You should have some proportion of pharma, IT, and then obviously you can have some cyclical, which can be a small portion of the portfolio because portfolio needs to be built from a longer term perspective. So you cannot have too many volatile elements in it. So I would recommend to be reasonably exposed and not overexposed to any high beta sector. That is the way we look at it.
All right. And what are you making for the FMCG space? Because we did see some urban slowdown this year as well. How can we approach the FMCG theme? Because we are seeing we are approaching the budget as well.
So in FMCG, we believe that there are multiple impacts. One, obviously the valuations were high and the growth rate have not come in line with what was anticipated. Also, there was some pressure on the margins, and because of that, because they were priced to perfection, they have come off quite sharply and underperformed in last few months. But I believe that these are long-term things and they have to be part of your portfolio. You may not make money in one period of time, but generally over a period of 3 to 5 years, these segments give good returns. So I believe that with government capex coming in, money going to the hands of people, finally they will go and spend in the basic necessities and daily use of products. So FMCG will definitely come back. Obviously, FMCG is a sector again which is a 6-7% kind of growth story. In good years, maybe 8-10%. So the returns expectation should also be moderate, but the amount of safety net which it provides is much better than few other sectors.
Okay, all right. We did talk about defense, IT and all the traditional names, but how are you looking at the new age counters? Because we saw an initial dip in the first half, but then most of them made a comeback in the later half of the year. How are you looking them from next year perspective?
So in the new age technology, the change which we have seen after the stocks got written down in first half of the year and second and previous year, that most of the management have now started focusing on profitability rather than insane growth or very high growth immediately, and that thing has brought interest back from the investor side. We are seeing many of these companies which were earlier burning a lot of cash, a lot of money, they have all started focusing a lot on profitability and cash flows, and that's the reason the interest is coming back. And in my view, this market is going to be there, and it's a big market and growing at a very fast pace. So the more while growth must not be left and market share gain should be the objective of the management, but at the same time we should not burn too much of cash, because in last 20 years I belong to this disruptive technology sector only. Half of my career was there, so I have seen that many good companies have actually went bankrupt and closed down because they were chasing market share at a very fast pace, and the others which were more rational and they left growth for some time but reserved their cash, they have actually become much bigger today. So the companies must keep an eye on market share, but at the same time on the cash flow and profitability, because without which they will burn out too quick, too fast. And if markets go the other way, they may not get second round, third round of funding or money from the investor. In that case, it becomes very challenging to run the operation. So my suggestion is that, while eyes should be on market share, but at the same time, you should look at bottom line.
Okay, we should always look at bottom line as well. But Sandeep, and we did talk about defense and railways that they still look expensive at this point of time. But any other pockets that you believe that there is an unjustified valuation, continues to be a froth in those pockets?
So the way we do our research and investment is that we generally don't go for the market leader in any of the space, and we try to further go down who are the vendors to them, and generally we have found that they are little unknown names, small companies, very good management, because if they are supplying to the market leaders in the defense or other spaces, obviously the vendors are good and they are doing good work, but they are little less known and people don't track them much, and that is the place where alpha could be generated, and we generally look into those spaces. So there are few engineering belts in the country like Chennai, Bangalore, Baroda, Rajkot. We focus a lot of our energy in these regions. We travel a lot on a regular basis, and we try to find out how the vendors which are supplying to these large listed players, how they are doing, and if they are listed, we try to evaluate them, and that is the way we find and we try to generate alpha for our clients.
Okay, all right. But on that note, we have to let you go, Sandeep. Thank you so much for your time, and we hope